Good morning. This is Ken Long from Tortoise Capital with a review of the weekend trading report for April 19th, 2015. Our market is in bullish normal conditions on an annual basis. Using the weekly RSI 14, we are in the middle of the neutral with a score of 55. Shorter term market condition, we're just slightly under the median at 47 out of 100 on the 10-day NDX. Looking at the market mosaic, you can see that price relative to the 200-day moving average is yellow bullish at 3.76, so that gives us 1.75% cushion between price and the sideways market as we define it. Slope of the 50 is white bullish at 0.33, still good. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and risk off is 1.0. That reading is at 1.07, so we are in risk on. Compare that to the last 5,000 trading days and find the standard deviation. That puts our risk Z, or the Z score, at 0.80. You can see a 90-day time series of that indicator here. After making a double bottom, we have a slight move up. This was a good move in XIV and the swing trade, but it's starting to roll over near a score of 1.0, so we're going to be careful about preserving profits we have here as the market is vulnerable. No change in the blended monthly rebalancing holdings. You can see the current leaders based on this price action as of the close on Friday. Theoretical exposure in ETF2 is still at 100%. The model portfolio is at 100%. We still have some slots available for the Kansas City workshops in June, and check the weekend report for an opportunity to participate as a distance learning member with swing trades, which will give you a $500 coupon for the distance learning workbook. I think it's a pretty good deal and an excellent research project. Quick look at the ETF 13 and 32 portfolios, still led by China, Japan, and U.S. small caps. The ETF Max. And notice I've added that 1 week and 1 month percentages into, along with the primary percentages indicated by for our system. Weekend version of the market health check. You can see the river in the dark blue shaded area, plus or minus 1 on the 30-period Bollinger Band. The river floodplain is the lighter blue shaded area. That's 30-period Bollinger Band, plus or minus 2. The red ribbon in the middle is the dragon, the river dragon. That's a 10-period Bollinger Band, plus or minus a half. The black lines are a 30-period regression line in the channel formed by the max excursion from the regression line during the look-back period. The 10-period regression line and channel are in blue. You see both are sloping up, although there was a move against them on Friday, but well within the noise channel. Still above the median of the river, so still favorable, although it did penetrate the dragon. This is a cause of some concern. That puts us into the yellow zone, so I'm going to follow the direction of the market in the intraday trade. So I'm prepared to go in either direction, and you notice the size of these daily candles. That's why I do that. If it gets back above this resistance level here, this price target at 212, then it's long and strong all the way north. If it fails below the Bollinger Band mean, we're looking for targets at the edge of the river at support levels here at 205, exiting the floodplain at 203.5, and then at the support level in the middle of this congestion zone here at about 201, and then you can see the 200-period moving average marching northward here. This black-looking sine wave is the slope of the 30-period regression line. You see the blue circles noting where it has crossed the zero line and it went positive for 30 days, and then where it made turning points at extremes. The last turning point was extreme here at a reading of about 0.13, across the zero line, and is now just slowly starting to decay. If you notice the slope of that line, still favorable, has not gotten to an extreme up move yet, but this is a concern here where it was rejected at 211.5 at the previous resistance. That puts the target back here at the Bollinger Band main, so we're fairly priced. This is a market that's exactly in the middle of its 10-day range. The jaws of percent price oscillator is still up, so we have a long-term upward bias still. However, we are alert to the possibility of more channeling, and that would not be surprising given the way the chop has gone for the last 40 days. And so that's why in the yellow zone here I am ready to go in either direction based on the market moves. I'm still taking swing trade signals, but I'm managing the intraday trade even more carefully because of the larger daily ranges that are available. Quick look at the ETF2 summary report. All the indexes are on buy signals. That keeps us at 100% invested. EFA at with a strength of 58, still better than the U.S. large caps at 55. Inside the U.S., it's small caps, mid caps, technology, then large caps. In terms of strength, the two strongest sectors, Japan and U.S. small caps, and the two weakest sectors being Latin America and Asia less Japan. World market model, the U.S. is all above average, as is Europe. Latin America really lagging along with Brazil, but emerging markets above average, most of Asia above average, really being dominated here by Japan and China, with Vietnam lagging. Another look at the relative strength leaders, only this time using the ETF2 lens. I'm always interested in the ones that are green and white, so green on strength, white on consistency gives us maybe catching these things earlier in their time frame. So Russia looking good, oil and gas after energy and oil have started to make their turn. The Internet Index, and then the Russell 2000 Growth Index, which is where that strength in the small caps is coming from. So that still looks good. That will give us targets of TNA and TZA. Shifting to the daily report, we have channeling signals in technology, mid caps and small caps, a bundle of good looking swing trade setups and channeling overreaction, 5 days down, triple screen in the auto framer. So plenty to choose from there. And more than half a dozen firing in the Dow 30 on the RSI2 tactical score, 4 signaling better than 2 to 1 on the auto framer, and again plenty of channeling and overreactions to choose from. The same story in the ETFs. We had 4 on the RSI2, mid caps, consumer discretionary, industrials in the NASDAQ, and then quite a few to choose from on the auto framer. So target rich environment here. The auto framer and the regression line fractal framework, for those of you framing trades on the basis of trade location. Again, plenty to choose from. Silver, real estate, the VIX. I like Johnson & Johnson, McDonald's, Walmart, and Home Depot here as trade frames. In the red are the ones that are relative strength leaders right now on the basis of how many ATR they've pulled away short term from their longer term fair value, which we compute as the 270 regression line. These in the green on the top row are the ones that are lagging the most, maybe some volume opportunities on the basis of how many ATR they are below their own 270. So again, Walmart, Microsoft, Procter & Gamble, and Intel. So good hunting, and keep your risk measured and your powder dry. Plenty of goodies to choose from going into Monday's trade. It is a trader's environment given an aging bull stuck right in the middle of its 10-day range. It's been choppy for 40 days, and it's right at the 50-yard line on the 10-day trading range. So plenty to choose from in both directions. Manage your trades and your emotions. Take good care, and we'll see you in the chat room.